Hey everybody, welcome back to Dividend Stockpile. Today I have a very special guest, Eric Beyrich, Co-Chief Investment Officer from Sound Income Strategies, to dive into their dividend-focused ETF, DIVY, the Sound Equity Dividend Income ETF. We're going to break down what makes DIVY unique, the strategy behind it, how it seeks to deliver steady income for investors, and why dividend-focused ETFs like this can play an important role in a long-term portfolio. So all that, Eric, welcome to the channel.
Thanks, Jeremy. It's a pleasure to be here.
Yeah, thank you so much. The DIVY is very popular in the investment community. So when we had the chance to connect, I definitely wanted to take advantage of it and get you on the channel so you can explain kind of what your strategy is and how this ETF can fit into someone's portfolio. A couple months back, I met with your other co-investment officer, Eric Beyrich, and we talked about your guys' other ETF, FXED. And that was a great conversation. So I'm really looking forward to finding out all about DIVY as well. Okay, so I guess to start things off, can you give like a brief outline of what you do at Sound Income Strategies and very high level of what the company itself does?
Sure. What I do is I manage the equity component of our asset management piece. We have mostly separately managed account strategies, and we also have this one ETF. We created the ETF really in 2021. It started at the beginning of the year for clients of our advisors that didn't have enough money to have a separately managed account to have proper diversification. So we started the ETF really as a loss leader to help people that didn't have as much money get the benefits of a high dividend strategy, the value of the catalyst high dividend strategy, and that was it. And it's grown reasonably well. Sound Income was traditionally a bond manager, and in 2020, you had this situation where the yields on stocks were higher than the yields on treasuries and bonds. So that's when they brought me on board to create the equity effort in an organized fashion. We started in a really a great period for this style of investing, and most of our clients are advisors who use it for their retired or facing retirement clients. So it was really a nice time to do what we do, and it was a perfect opportunity. Sound Income itself as a company really caters to investment advisors that focus on the income method of investing as opposed to capital appreciation. So the idea is you want to have enough cash flow without selling any of your assets to pay your bills, and that's very appealing to a lot of people, and it's particularly appealing to retirees.
I love your income first approach. For a lot of investors, we're not necessarily looking for. A lot of investors aren't really looking for that capital appreciation. They just want the income to come in to pay their bills. And so something like this is a great approach. And it's nice to know that even though the ETF's only been around for 4.5 years, you guys have been doing the strategy for many, many years before then in your separately managed accounts. So it gives you even more of a track record.
Yeah, we have a long track record, and I would just argue one of the reasons why our fund is different and why we think it's compelling is we only focus on qualified dividend payers.
Mm-hmm.
So there's no MLPs, there are no REITs, there's no preferred stocks. So we have very tax efficient holdings, and also we have holdings that generally have a reason why they're going to improve fundamentally. One of the knocks on high dividend stocks is they have high dividends for a reason. Usually it's because they have very low growth. And we try to offset that headwind by finding companies that are engaged in some structural reform or trying to improve themselves.
Mm-hmm.
Usually that takes a few years, and that also contributes to our very low turnover rate, which is about 20%. And that's just the nature of the strategy. So if you're a patient investor, if you're willing to let companies go through the process of fixing themselves or a cycle to turn from being negative to positive, this can really work out for you because you get paid a high yield, and then at the tail end, you're going to get a nice capital appreciation typically. So if you get a longer term benchmark that might be compared for dividend, you look at the dividend aristocrats, they similarly have had these mid-single digit return years over the last few years. But over time, they've had almost 10% average returns. So it's actually a nice, risk mitigating strategy. You're not as concentrated in these very expensive, high expectation stocks. So you should have lower volatility and higher, Sharpe ratios over time. In the case of our stocks, what we typically see is that we're buying things that are unpopular and unloved,
Mm-hmm.
and usually it takes 18 months for them to come back into favor. So it's a balance of buying things that aren't working because those are giving you the fattest yields and the greatest opportunity, and harvesting things that are working and not getting caught off sides by having too much of one or the other. So we actually like it when the price of stocks fall because that allows us to buy things cheaper. But most people, when they see that they own something and the prices fall, they get very upset. And so you have to educate people a little bit that lower prices are fine when you're buying; they're only bad when you're selling.
Right.
And
Exactly.
that takes time.
Yeah, and as an active manager approach, you look at those individual companies to determine where they are in the cycle and where they are in the valuation. You can make that determination instead of just going with an index approach where you get the good and the bad and the overpriced and underpriced. You have a much more control over what you guys invest in.
Yeah, and sometimes you buy things knowing they're going to go lower. Like you'll buy chemical stocks when the Fed is raising rates, knowing that all the end markets that they go into are going to get pressured. And so you're hoping to average down, or you're hoping to be there and know and say, okay, now's the time to back up the truck.
Yeah.
In my past, I had worked for a company. This was a KR Capital, and one of the principals there made a fortune by just buying cyclical stocks.
Mm-hmm.
There was an old investment firm that had a conference called Invest We Trust, and the whole idea was to buy things when they were the ugliest.
Yep.
And wait for them. Well, we're not quite that extreme because we want to get cash flow and yields to pay the dividends. But a fantasy would be to buy all the deep cyclicals when they're on their butts, because then you're going to get the greatest return on appreciation. Well, we have a situation where you can buy some of the cyclicals, and I'll put out the material stocks, where they still have enough to pay the dividends or to pay dividends, but they're trading on an enterprise value to replacement cost level at 30 cents on the dollar now, and you usually don't see that in recessions. Usually they only get to 50 cents on the dollar.
Yeah.
But you just have to have the patience and durability to hang on and live to the end. And investors today, they don't seem to have that. All they want to do is ride the momentum of the AI trade, and when that train wrecks, then I don't know what's going to happen, but it's probably going to be pretty good for us.
Yeah, exactly. The cycles come and go. I mean, that's the life of a value investor. That's the life of a dividend investor. It's not always going to be the end product or end demand type of investing.
Absolutely. And I should contrast it to bond investing. A lot of people are really happy. They don't pay attention to bond prices as long as they get their check every 6 months from the bond. Well, the better thought is look at the lifetime return, not just the incremental return. One of the great things about equities is they're an inflationary pass-through vehicle.
Yep.
So if the costs go up and the prices go up, it gets passed through the company as a machine almost, and your dividend payment goes up too. So there's automatic inflation adjustment factor plus any fundamental growth in the economy or in the stock. So if you actually look at the income versus your needs, the income for dividend paying stocks typically grows in line or greater than inflation. Certainly it has been greater than inflation, although share repurchases have now siphoned off some of the aggregate dividend growth. But you can actually have a situation if you're using dividends to fund your retirement where you actually have more income on a real basis over time, especially qualified dividends that are tax efficient, as opposed to fixed income. You have to pay the highest tax rate if it's a taxable account, and it doesn't grow, whereas inflation does grow.
Yeah.
So, I'm a real believer in using dividends for retirees because of that factor. And, both factors, I should say, the tax efficiency and the growth.
Yeah, definitely.
For most people, when they retire, and then they're supposed to work, on things they like for the next 20 years and then die.
Yeah.
So if the average retirement were only 20 years, you'd say, okay, well, then the cost of things is basically going to double if you have a 3.6% inflation over that. Well, if you have fixed income and the cost of things double, you're going to be pretty poor in the last stages of your life.
Yep.
So I like to think of it as if you keep all your money invested in high dividend paying stocks, your income will not only grow, but so will the value of that pile. So instead of depleting your portfolio, you'll actually have a bigger portfolio, and you can use that for medical bills, for your children, for legacies, for whatever you want to do. And I think that's a better strategy. I mean, yes, there are required minimum distributions for retirement plans and things, and not everybody has enough money to live off their dividends. But incrementally, it's, I think, a smarter way to go, because you're not basically cashing out probably too soon. And I'll use a little bit of a personal example. Women are expected to live longer than their husbands unless they married a younger man. So, uh, my life expectancy might be 20 years, but my wife's is 35.
Yep.
So she's going to need that money for longer, and I don't want to rely on some, rule of thumb that's not mathematically based on anything, and have her find out she's out of money. So when I look at it for the portfolios, I only have a 3-year window that I can see for the stock. So that's sort of the cycle, but I know the compounding benefit if people, reinvest those dividends until they need them is going to just amplify the wealth later on.
I was hoping to transition over a little bit more about the logistics and the details of your fund.
Okay, I'll give you the structure of it. Typically, it's the 35 stocks. It can go as low as 30. The most I've ever had is 36. There's no, you have to commit suicide if you have 34, if you have 38. But the goal is 35 stocks. The average position about 3%.
Okay.
There's a lot of them that are, more like 1.5% to 2% that are small. We have a few bigger ones like Citigroup and Enbridge that are 5%.
Mm-hmm.
And part of that has to do with how they perform, and part of it has to do with the conviction that we have that they're going to be safe and steady. We have a lot of smaller positions that we know are a little risky, or they're not quite ready for prime time, and that's just the nature of it. Typically in a portfolio, the top 10 positions make up 40%.
Yeah.
But anyway, that's sort of the range of how we do it. The goal is to be diversified. The only sector we can't own is our REITs,
Mm-hmm.
non-qualified.
Yep.
And we have a rule that you can't own more than 25% in any one sector. So, for example, the S&P has 35% in technology alone. We couldn't do that. In fact, we only have about 10% in technology, just because things don't fit our criteria. And even those stocks have very low yields. Typically, our minimum yield is twice that of the S&P, which would only be about 2.2% now. Our underlying yield is 4.5%. Typically, we really look for things with 4% yields. Yeah, so really, we're giving you broad economic diversification. We talked about the S&P 35% is in technology index. If you look at the high tech names that are in consumer discretionary, that are in the communication sector, the S&P is actually more than 50% technology, so on a cap-weighted basis. And usually when the scales get so tilted that way, like they did in 2000, there's some form of correcting factor. I don't know how great it will be, but the S&P no longer represents the broader economy. It represents the market cap, momentum-driven, largest technology areas more than anything else. So we're different than that. We are really more economically focused. And if the Fed does cut rates as we expect, not only will yields become more scarce, which will push up the price of our funds and make yields harder to come by, but it will also help the broader economy that requires financing to buy things, whether it's cars or houses. And that drives more activity typically than AI and technology across the entire economy. And we think that's starting to happen, and that will be very positive for us.
Okay, so it looks like it's a payout of 3.9 cents per share every payout, and then as you said, there's an extra payment at the end of the year to finish it off, and that gives you that a little bit over 4% yield right now.
But Sound Income Strategies we have, if you go to Sound Income Strategies, I'm sure there are fact sheets that can be downloaded, and there's somebody there if you have questions that can answer it, or you can talk to me. I'm very accessible, maybe too accessible. We appreciate your efforts to get the word out, and we need it. There are so many ETFs out there, and there's so many other alternatives of things to invest in. The market is noisy, and we just want people to have not only what we think is best for them, but have them get an understanding so that they have an opinion as to what's best for them, that's informed instead of just driven by the hype news media that talks about whatever the flavor of the day is. We're not flavor of the day. We're more long-term, lower turnover, contrarian, if you will, and we're trying to buy things that make sense for people that we know don't have a lot of money to waste. So that's the idea.
So
Yeah,
just to kind of wrap things up, we're talking DIVY, Sound Equity Dividend Income ETF from Sound Income Strategies. We can go to their website to get some more information, which will pop up on now. All right, Eric, again, thank you so much for joining. Really appreciate your time. Everyone go check out DIVY, see if it fits your strategy. Definitely reach out to Eric and his team if you have any questions. And Eric, hopefully we'll talk again soon. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.